Hello everyone and welcome to this month's Ask the CFP segment. This month's question is, how does the Federal Reserve Bank raising rates affect me? It's common knowledge today that interest rates are increasing to fight high levels of inflation. Interest rates vary for many reasons, but are largely based on the rate set by the Fed for lending between banks. If lending between banks becomes more expensive because of higher rates, those banks pass on the higher cost to businesses and consumers through higher rates on loans. This is where we find the answer to this month's question. How the Fed's rate increase affects someone's finances depends on their financial situation. For example, if you're close to retirement and have a pension, rate increases are likely to affect the actuarial assumptions used within the pension. If you have the option of taking out a lump sum payment, your lump sum estimate may decrease as rates increase. That's because lump sum pension payouts are based on the amount of money needed to provide income through someone's life expectancy. If the pension can rely on higher rates of return on bonds, then less money would be needed to provide that income through their life expectancy. Lump sum pension payouts aren't for everyone, but if you've been considering it, now may be a good time to review your options. Aside from pensions, some people may welcome the idea of higher interest rates, especially if they like using CDs, money market funds, or other fixed income investments. Higher rates means higher rates of return for these typical types of products. However, for anyone that already owns fixed income investments such as bonds, it means your bonds will decrease in value, at least on paper. A bond purchased 4 years ago may be worth less today since someone could buy a brand new similar bond at a higher rate today. This has been a tough market for bond owners because of this inverse relationship between bond values and interest rates. Keep in mind though, as bonds mature, they generally receive their par value back. This means the lower value you see on paper for a 4-year-old bond may rise back to its original par value if held to maturity. Lastly, for anyone relying on debt such as mortgages, business loans, or student loans, the cost to borrow will likely increase as the Fed increases rates. Mortgage rates have already seen increases from approximately 2 to 3% to 5 to 6%. For this reason, if you need a loan, it may be wise to lock in a fixed rate now before further rate increases occur. When it comes to funding college, this is a great example of how proper planning and saving to a 529 plan can reduce or eliminate the need for student loans in the future. Cash isn't always king, but it certainly helps to have it when loan rates increase. Overall, rate increases cause change, and change causes volatility. During this volatility, we must remember why the Fed is increasing rates. It's all in an effort to lower inflation to around 2% long term. If you have a question about this topic or have an idea for next month's video, please send it to tfreeman@monetagroup.com. Thanks for watching, and we'll see you next month.